Hey everybody, welcome into Mining Stock Daily. This is this week's long form episode. Trevor Hall here as your host this week. Once again, we've got a good conversation with Bloomberg Intelligence, Mike McGlone. Mike has put out a lot of kind of analysis and thoughts regarding a recession incoming here in the United States. He thinks it's going to be quote unquote one for our lifetimes. And we talk about those predictions, what he's seeing, why he's going out there publicly and speaking about his thoughts and what could be imminent. We also talk, obviously, the big news this week was out of China, what's going on in Tech Center, and why we should be paying attention to Chinese President Xi very, very closely. Great conversation, lasts a little under an hour, and I think you'll get a lot out of it in its entirety. Special thank you to Western Copper and Gold, Fireweed Metals, and Arizona Sonoran Copper for their continued support of the podcast. We put out a lot of corporate interviews, including some new introductions this week. Go back to Mining Stock Daily, maybe pick up on some of those conversations while you are en route to the Beaver Creek Precious Metal Summit. We'll be reporting from there next week. And if you wouldn't mind, hit that like, subscribe, share all those good things on both the YouTube channel and on the podcast platform. All right, let's jump into my conversation with Mike. Have a wonderful weekend. See you on the flip side. Hey everybody, welcome into this week's long form episode here on Mining Stock Daily. It's going to be a big one because there's an important conversation to be had. Lots of news this week from commodities, but also in the geopolitical situation happening between China and the U.S. and the tech sector there. I had Mike McGlone from Bloomberg Intelligence booked. Little did we know we'd have so much to talk about. So, Mike, welcome to the podcast. How you been?
Hello, Trevor. I'm good, and thank you for having me. How about you? How are you?
I'm doing great. Yeah. Fall has sprung here in Colorado. We have a big precious metals exploration conference next week in Beaver Creek that we're going to be very busy with next week. So, yeah, I'm great, man. I'm really good. So where do we find you these days?
Oh, good. I'm in Miami. I've been here 2 years this month. I moved from Gotham City after doing my 3 decades of trying to make it there, and now I'm trying to make it here.
So you are with Bloomberg. We love Bloomberg in my household. My kids love to watch it 5 days, 5 mornings a week. Wow. I say that facetiously.
That's impressive.
That's usually what's on during breakfast. But talk to us a little bit about your career. You've been with Bloomberg for a little over 7 years now, it seems like. But
yes,
you do have a number of years in background working in markets and commodities.
Yeah, I started in the business in the trading pits in the 80s in Chicago, those Rosh's trading pits. And I like to say of all the numerous degrees I have, master's degrees, the 5 years I spent in the trading pits is bar none the most I've ever learned in a short period of time. And I go back to that virtually every day when I write things. And we're probably going to be talking about China. And I posted today the acronym I learned in the trading pits when you had a customer who was needing to get out of position. Sometimes the term I heard was GMTFO, get me the heck out. And I feel that's what's going on in China at the moment.
Yeah. Oh, let's table that because that's going to take a long time here because there's just actually hell of it. Let's just jump into it because that is the news of the week here, Mike. This geopolitical tension. Listen, it wasn't long ago where the U.S. government, the administration was pushing against Huawei technology, and now we're seeing China push against U.S. and Apple technology, specifically iPhones. I just did a quick Google search here this morning, Mike. I was just kind of curious, okay, how big is the Chinese government as far as how many people are employed there? And just rough estimate numbers, going to Wikipedia's basic Google search, I came up with over 110 million people out of a 1.4 billion population. That's a lot of people.
Yeah. It is. Well, it's 1/3 the population in the U.S. approximately.
So how does a company like Apple? I mean, how do investors put a valuation on that? I mean, we're seeing the moves in Apple, but this is nuts.
So what you mentioned about Apple to me is a tree in the forest of what's happening in China.
Mm.
To me, this is one of the biggest global economic paradigm shifts of our lifetimes, and that's not so much China, it's one person. And watch what he does, ignore what he says. So Mr. Z cozied up with Mr. Putin, unlimited friendship before the invasion of Ukraine. So there's a hot war going on, he's somewhat involved in. There's a Cold War clearly going on. And he pushed back on people like Jack Ma, really pushing back on capitalism. Those are just macro things that have happened a couple of years ago, almost. It all started, the first signal was when he banned Winnie the Pooh in 2015. We can go back into that later. But those were some of the signals. So to me, this is a complete shift, paradigm shift in what China was to the U.S. when President Nixon went there in 1972 to help offset the Soviet Union in the height of the Cold War. Now, Mr. Z, leading China, has cozied up with the former Soviet Union and are part of a hot and a cold war and is really pushing back in free market capitalism. But by doing so, he really upset his best customers, best export customers, Europe and the U.S. And the data is extraordinary how quickly this is happening. The GMTFO, they get me the heck out of China. Now, for the first time in 20 years, the U.S. imports more from Mexico than it does in China. Now, those are just, I think, bodies in motion just getting started. Both sides of the Congress are completely counter China, and you sense it with 6-year-olds now. When, Daddy, are you doing business with China? It's not the country that hates us now and is pushing this war, and it's not the country; it's one person. So it brings me back to when I think of China, I think of peak Japan, 1989. The Nikkei peaked around 40,000, still hasn't taken out that high. It's around 32 now. Peak Soviet Union, wall fell down in 91. The Berlin Wall, and Atlas Shrugged, the Ayn Rand novel. It's just playing out completely like that. And the key question is what stops this trajectory? I don't see it right now. So here's another. So I mentioned the U.S. importing more from Mexico. There's certainly a major decline in European imports from China. There's what's happening in Germany, one of their best quasi-customers. Germany's completely tilting towards recession. But then there's also things that are more real time, and that's rates. Two-year note yields in this country are almost double two-year note yields in China. They are cutting rates. They're one of the major economies in the world that's cutting rates. Some are catching up, partly because they have to, because crisis of confidence, the economy's potentially, I think, collapsing, but you'll never hear that because it's not. They don't have that free flow of information, capital, and discourse. And the U.S. rates, two-year note yields are 5%. In China, they're 3 and 2% or so, maybe below that, and around below 3%. So that's the highest since 2006. So there's that trend, the trajectory I see, the widening rates, the widening disparity, and the get me out of China. I think it's just getting started. So I look at things like crude oil and copper. I'm like, yeah, good luck with that one. These things always mean revert. Typically, crude oil always means reverts, and I think it's just going to get much lower. And I think that engine of economic growth is going to do similar to what Japan did. Japan gross domestic product peaked around $4 trillion in '89. It's the same since. I fully expect China, which is bumping up near 20, is going to drop and maybe be peaked similar to that. So key question is what stops this trajectory, and that shift, watch what he does, not they, he, is significant. And I don't think we're going to really know how significant it is until the benefit of hindsight.
There's a number of headlines out of China that just have you scratching your head if you're an investor. And we can go back last year to the Evergrande property fiasco. It sounds like there still continues to be property issues there in that market. But even just if you look at the Hang Seng Index, it's hanging on, by a cliff, it almost appears. And we've seen news that they are trying to work on ways to stimulate that market, but it maybe provides a little bit of stabilization for a day or two, but then we see continued selling throughout the day. I guess how much of this is maybe for Xi is strategy for a new way of working, a new economy for China, maybe bringing Russia a lot closer and moving the West further away, and how much of it is it more or less the global economy just calling foul here, Mike?
All the above. I think the one thing we need to reiterate is certainly learning from the lessons of my readings of history is a good book written by Richter Shivitz, called The Great Rupture, really covers China well. They're really going back to the days of, I think it was the Ming Dynasty enclosure. But it's one person with a really unique ideology. I guess the unique view of history and where we should be going, they should be going. And I don't think it's the average person, particularly what's happening in Russia. Most people, I think, were very upset when, oh, you're going to close us off to the rest of the world. We can't buy American blue jeans and cigarettes and watch movies anymore. Stuff like, the simple stuff. But it's that's the kind of thing. It's unique. It's something that was overdue to happen. Notably, if you watch the last 10 years of rapid economic growth in China, it looked really like a paradigm, like a Ponzi scheme or just a bubble. The property crisis is very much not unprecedented. I mean, we've seen it happen in almost every major rapidly advancing economy in history, and it's happened in this country in certain areas, but certainly it happened in Japan. And typically these things need a major catalyst, and the catalysts are as sufficient as I've ever seen. First of all, Mr. Z, the war, and things that, like, Mr. Trump got started when he pointed out the theft of intellectual property. And some of us knew this decades ago. I worked at a firm on Wall Street, and we had a Chinese national office. Really nice guy. He left. He went back to China, and 6 months later, NASA showed up in the office. Says, "Oh, someone was hacking into the NASA system from your office." I had very close contacts at University of Connecticut, Yukon. I met with the president recently, and she told me about how much problems they've had with Chinese students there. And issues with spying and things like that. So this is nothing new, but it's the case now of the tilt towards the former adversary, and that is the Cold War. And it's bringing with this hot war too. And if there's one person on the planet who could stop everything right now, it's Mr. Z. But he keeps pushing the other way, like you mentioned with Apple. And until we see a major shift in this person's focus and goals with how he's leading China, it's complete reversion. I expect you just expect these massive pumps to reverse. Now, if China had been like India, kind of stuck in the mud for the last couple decades, it's not a big issue. But they've gone so far, so fast, and they're such a demand pull economic engine of the global economic and force that just a little bit of reversion in that is what I expect, and there's good reason for it. The most central banks in the world are still hiking rates rapidly. The U.S., even though we have this severe tilt towards recession, it's already showing clear signs of recession in Europe, and yet central banks are still hiking rates. Those are the main export customers for China. So I see a lose, lose, lose. I don't see what's going to change it, and I'll be delighted to see something that could change my views.
How about imports into China, and especially on the back of food and agriculture commodities? U.S. has historically been a huge exporter of agriculture products to China because they need that. Now, if these ties are severed or become entangled, like, does Russia even have enough output to provide and make up for that difference that America has been providing for China?
Well, let's start with grains. The most significant are corn, soybeans, wheat, most notably soybeans to China. And here, this relationship you just mentioned now is part of the reason I'm almost always focused on the autocorrelation factors in things that you can grow. And you can grow petroleum nowadays through ethanol. But for instance, the price of corn popped in there 8 last year. Now it's 4. Price of soybeans got near 17. And now they're 13. And that is, now we're seeing a paradigm shift on the planet of massive supply coming out of Brazil. Brazil supply has been an upward trajectory for about 2 decades. It's just going convex now. And that's on the back of prices. So never underestimate what high prices will do for supply, particularly in something you can produce within a year. And so now the largest exporter and producer of soybeans on the planet are Brazil. They surpassed the U.S., I think it was in 2015 or so. Largest producer of corn, and that's from Brazil and Argentina. And so China doesn't need us for a lot of this stuff. And so we have a problem there. U.S. farmers have a problem there. In addition, I look at what's happening with this massive shift to EVs in this country. 40%, almost 40% of the corn crop in this country is for ethanol, for corn, from corn, for motor vehicles. Yet that demand's declining rapidly, and EV sales are picking up rapidly. That trend is not good for grain prices, which is good for the U.S. in the short term. Right now, grain prices are elevated, akin to how they were in World War I, when there was a war in Europe, and the U.S. grain belt did very well because it boosted prices well, and the U.S. grain belt did very well. Now, I was in the grain belt last week, and we're going to have a pretty good crop despite adverse weather. And it's good times at the moment. You got the price of corn around $5. I mean, it's always based. Corn's the most significant agricultural commodity. I think it's going to go to 4, but the current price now is well above the cost of production. The last 10 years is basically flat versus the cost of production. Now we'll just look at the main inputs for producing corn. That's anhydrous ammonia. The price has collapsed. I mean, it's collapsed 50, almost 60% last year.
It's because of natural gas prices.
So there's another key thing. So I always like to point out, particularly when the key thing about commodities is a higher price cure, and we're in that back end of the higher price cure right now. Prices pumped the most last year on many scales, crude oil most ever on a 2-year basis, and now they're in the dumping phase. And it's natural gas is a key one. U.S. natural gas got up to around 10 million BTUs. Now it's back. It's hovering around 2 and stuck. It dropped 80%. We can just produce more with less every day. So that's the bottom line. I like to point out about it. We're tilting towards a severe deflationary recession, and certainly if you look at commodities, they've been in a good deflationary indicator for a good portion of the last 10, almost 20 years.
Before we talk about your kind of forecast, and I know you're a big deflationist, I guess you could say, but one more question about China. It probably doesn't stop here with Apple and iPhones, does it? I mean, what about the manufacturing, Foxconn in general? What about the other tech companies that for the last 20 years have been trying to get a strong market presence in China? Is this at a pivot point to maybe breaking or going away?
Yeah, I think everything's at a pivot point of breaking and going away. There's complete understanding on a global basis that it's very difficult. If you can find alternative sources, do not do business with China until something changes with Mr. Z. Unlimited friendship right before the war, and quote unquote from our president, ticking time bomb, heed the warnings. I just see that right there. So I don't know exactly what's going to happen with Foxconn, but to me, the next key thing I'm really worried about is CEF, the CEF factor, someone else's fault. It's one of my favorite acronyms. You talk to people sometimes, I'm guilty of it sometimes myself, someone else's fault. That tilt as Mr. Z loses popularity, as confidence declines, which is unlikely to go up unless he just throws money at the system, which means the collapse in yuan, blaming someone else. And so far that's already happening. When Trump first started this, pushing back in 2018 and pushing back on intellectual property theft, he started with the CEF factor. It was all U.S.'s fault, yet it was the U.S. who brought the average Chinese citizen out of being a peasant. Yet now it's switched back. So I'm worried about that. I'm worried about the war, potentially going nuclear. And these are just bodies in motions at the moment. And the key question is, it gets worse every day. I don't think there's anything to change it. And the U.S. has reached out. How many senior U.S. people have really stepped over to China the last 3 months, to try to help alleviate things? And it's not been reciprocal. So I think we're getting the message, and at least we're trying. And to me, this is a major boom for America. North America, South America, Mexico, and it's a major reversion potential in China. I mean, in all of Asia. Key question is what stops it. Now, here's a big issue. Now, as Europe is already tilting towards recession, is still raising rates. The U.S. is just an inevitable matter of time, within who knows how many months, maybe within 5 months, and still raising rates. This is the scenario for a pretty severe global recession, potentially akin to the 30s.
Okay, so let's transition to that, because in a previous interview, I've heard you say your prediction: worst recession in our lifetime. Obviously,
so that's a simple. I'll let you finish, but to me, what's the simple measures and lessons of liquidity pumps in history. The book, The Boom and the Bust, points this out. That dump. And almost every major asset bubble in history that comes on the back of liquidity pumps that dump collapse into deflationary recessions. That's just a fact of history. I'll end with this, and I apologize for interrupting your question. This has been the biggest liquidity pump in history, bar none, and the process is still dumping. And just look at U.S. Fed funds; we're still looking for higher rates in November.
I guess my follow-up question to this, and you're not the only one out there with that type of prediction and publicly speaking out on this. I guess my follow-up question is, what will be the response from politicians and central bankers? Will that response be any different now than we've seen in the past 100 years?
Yes and no. The answer to the question is both. The first response will be something that's going to be ingrained. I don't think people picked up on yet is once we start tilting towards the stock market going down, which almost always happens recessions, particularly when the earnings yield in the stock market is so much below the T-bill rate. That there'll be a response typically almost every time in history when the stock market's down 20% on a 12-month basis, the Fed has eased. I can go back to 1950, almost to 1900 and show you that fact. The only example is 1988 because it was after the stock market crash and it distorted things. And the difference this time is like the lessons of the Weimar Republic in Germany. We will not ease with the ease we have in the past because of the inflation that was created due to too much liquidity during COVID. Now, there was legitimate reason for that. 3 years ago, there was a good potential. There was risk. There was fear that a lot of us would die. Now, we got through that quickly with vaccines. What country failed the most on that? China. Their system did not allow that to the intellectual property of creating vaccines that quick. But the point is, we're in the back end of that dump. We're still dumping. And here's a key fact that politicians will always prime pump as much as they can. But now we do have a Republican House and a Democrat president. So there's a little bit of check and balance there. It's not like Biden had those 2 years when it was completely Democrats and he pumped the system with so much liquidity in terms of fiscal stimulus. That's going to be harder to do, obviously getting towards the election. But the key thing is a little bit divided there, but the bottom line is liquidity. The Fed is the number one factor to help liquidity bottom all markets. And I'll give you the best example in history is 1933, when President Franklin Delano Roosevelt debased the currency versus gold. That bottomed deflation, the bottom of the stock market within a day of March when he did that. I mean, you can just look in at charts. I can show you it. When gold went from $20 an ounce to $35 an ounce approximately, boom, everything bottomed. It was over. But look what we had to do to get there. That's the trajectory we're heading towards right now. The difference is this pump in liquidity we had is bar none well past what happened in the 20s, basically 1924, when the Fed cut rates the lowest in the world. And it's still happening. We're still hiking rates. So I'd look at it one bridge at a time. The next major shoe to drop, I think commodities already collapsed and bounced a little bit. Natural gas has collapsed and bounced a little bit. PPI has absolutely, the producer price index, finished goods has dropped to the highest, the greatest velocity in history since 1948. 18% to -3, now it's hovering at -1. That's deflation. Cryptos have collapsed and I think are still heading lower. The bottom line stock of the bond market's collapsed. Housing's rolling over. Okay, it's bounced a little bit. New homes, existing home sales collapsed. The key thing is the stock market. Now, once that rolls over, I didn't say if, it'd be wonderful if it turns out to not roll over, then all the dominoes fall. And then you'll start seeing the problem right now, Trevor, is you look on the WIRP function on the Bloomberg terminal, shows you what the Fed's doing. It still shows at the November meeting, there's a 40% chance we're going to hike rates another 25 basis points. Nothing has basically ever bottom in these scenarios until you have a lag to Federal Reserve easing. So I'll just end with this, the last two examples. March or so, 2009, the stock market bottomed. The Fed started cutting rates in September 2007. February or so, 2002, the stock market bottomed. The Fed started cutting rates at the beginning of 2001. Right. There's a trend there. The problem is we're still hiking rates, tilt towards recession, and that we're in the back end of. So I see this trajectory towards severe deflation, which is not profound at all, because remember what got us this inflation. It was just what Milton Friedman warned us about was monetary phenomenon always, and we pumped so much money in the system, we're still taking it out. But here's the problem is because the stock market's bounced, because we've bailed out the banks in March, which was, taking back all that quantitative tightening in like a couple weeks. And because of this massive fiscal stimulus, the Fed has kept hiking rates another 100 basis points this year. And I'd like to start out with the number one thing I got wrong was I did not think they would hike rates much above 3%. And here we are, we're looking at Fed funds rising to 5.45% in November. And what's the average yield on the stock market? It's much below that earnings yield. This is again, that's a problem. Bodies in motion, still motion. So we need to at least first see light at the end of the tunnel. The Fed to start easing before you can expect risk assets to plateau, and I think they're just getting started. The problem here's this. The problem is it's unlikely that there's going to be any market pricing for easing until the stock market tells them to, which is what has happened historically.
It's fascinating about this idea of easing here on the back of its expectations that inflation potentially and most likely will tick a little bit higher into this fall. I mean, just on the back of energy prices alone, Mike, we could potentially see a higher CPI print. How closely? I guess how close? What are your inputs or what your metrics are you watching to get a good understanding of inflation in the short to mid term? I mean, or maybe the big picture here, Mike. I mean, are you talking? Is inflation dead? Are we going back to 2%, or are we going to tick higher before that 2% is even met?
Well, you made a good point there, Trevor, for ticking higher. So there's so many examples of these little blips in history, but it's the macro trend that matters. Inflation blipping higher, the core measures, personal consumption expenditures, super core measures, employment cost indices running around 4%, which is double the Fed's target of 2%, is part of the reason the Fed will stay ticky, and CPI picking up because energy's bounced a little bit recently is part of the reason for the lose-lose. The Fed is going to stop, is going to keep its finger on the tightening button and off the liquidity pumping until it's too late. Not too late, until its markets have really rolled over. That's just where we're heading right now. You have to expect something very unusual in history, is something that's never happened, to have liquidity leave this fast after it's pumped this much, and then just to hover into a nice plateau of solid calm market. So one of the key measures I watch is the producer price index, and I mentioned it dropped at the fastest point in history since 1948, from 18% to 3%. Now that is your first sign that it's different this time. So I do love, and I'll be publishing on tomorrow when this hits the tape, on the silliness of expecting a soft landing when most of these metrics measure things that have never happened. Money supply jumped up 40% on a 2-year basis, and now it's negative. That's never happened. Okay, our data goes back 60 years or so. It's hard to measure it back to the stock market, back to the 20s. PPI, it's never gone up that much and dropped that much. Crude oil on a 2-year basis went up 460%. It's the high during the crisis in 74 was about 300%. Every single time we pumped near that, it's only been 3 times in history, 1999, 90, 2000, and 1974, we've had a recession. But what was the foundation for crude oil pumping to the highest relative price ever? Is in April of 2020, it settled at negative $36 a barrel. That's never happened either. So there's so many things, so much stuff that's never happened before. You have to use, I view, the lessons of economics, history, and models to me, says to say we're going to have a soft landing environment. I think I can understand when someone's on the sell side and doesn't want to scaremonger. My job at Bloomberg Intelligence is to point out the facts of what I think are going to happen and to be right in the long term. And if I'm wrong on this, throw me under the bus. I'm sorry. I did say crude oil was way too expensive above 100 last year. I fully expected to go to 40, and the low this year is 63. Sorry, but it didn't go to 150, what most people expect. And I still think it's going that way. But these are the most significant. There's so much unique things happening that you really have to, every weekend when I get time, I dig back in the history books as much as I can and reread stuff I learned about or forgot and relearn stuff and try to get a sense for what we should expect to happen. And that's what I write about. And I see the data on the terminal. So that's where I'm pointing out. I'll be publishing the silliness of a soft landing when I point out the crocodile jaw charts. One particular one is interest rates going up, home sales collapsing. Interest rate going up, PPI collapsing. Interest rates still going up. The 100-week moving average on most stock markets, particularly the Russell Small Cap Index, rolling over. That stuff's just really never happened. Yet interest rates are still going up. So this is a classic case of the Fed went too easy for too long, benefit of hindsight, and now they're staying too tight for too long. But they have reason for that, and because their metrics for inflation are still sticky. So this is, I would wonder, it'd be wonderful if we get some kind of soft landing on. But I think the normal lessons of cycles are just kicking in. And here's one example was what happened to natural gas.
Yeah. I question the soft landing narrative. I think the better question is, how long does the central bank stay tight in some sort of market
Yeah.
problem? I don't think they have the luxury of just jumping in and providing liquidity and saving the markets the moment there's blood in the street. Nor do I think that most investors, Mike. I mean, I'm 40 years old. I've never known a market where the Fed doesn't come in. That's how
There you
scary
go.
this
Check mark.
is. And
I'm
there's
glad
a
you
whole.
pointed it out. Most people have never, are like you, they have not seen that. A market where markets go down, a bear market, and the Fed just doesn't save you.
That's right. So if we have a whole generation of investors, whether it's on the retail side or even working in institutions, how prepared is market participants for a Fed that just will continue to sit on the sidelines and say we're data dependent, we're going to stay tight because inflation matters?
So that's the most important part of markets is human nature, and never forget where you're from. And so the human nature is most people, I'm 58, so I've seen a few of those. And I remember bear markets that go down and stay down, and Fed helps you, but they still stay down. It takes years. This one, they're not going to. They can't because something that happened. But one thing I need to point out first, we'll start with the stock market. It was the most expensive ever versus GDP right before at the end of 2021, before the Fed started tightening. It was the most expensive ever versus the rest of the world. MSCI US index, highest ever versus that index. It's most expensive ever versus US housing market. Most expensive ever versus sales. I mean, those are the key metrics, and it's just reverting, and it has a solid good reason to do that. I look over at this US government too, around 5% and guaranteeing about getting about 10% in the next 2 years. Thank you very much. PPI is negative, CPI is below that. They're all heading lower. They're probably going to go negative. Yet in 2 years, if you clunk $100 down into that 2-year note, you're going to get 110 guaranteed. Why, just people have to, basically what has to happen is the mantra of market's going to go up because it's going to get up has to get stopped out. This is a symbol I learned in trading pits that's called hitting the stops. That was a symbol, and that's what always has happened. And this is just one of the best recipes I've ever seen for the big stop. Now, what we did see this year was a big short cover. I mean, the amount of shorts that were in the market at the beginning of the year, I was bearish and got the bounce. But those shorts are out now. And so that means when the data starts turning over, which is just a matter of time based on the normal lag, the Fed hikes, and then it's going to be, I think, market's going to go down because it went down. That's going to switch from it's going to go up because it went up. I mean, that worked for decades. In fact, there's so many cases. In 1987 crash, the Fed cut that day. Welcome to the new world. This is not going to happen. And it happened. It took forward the highest. But think about what happened, Trevor. It took almost a unprecedented event. Global economies never shut down intentionally, directed by its governments like it did. We never pumped that much liquidity into it as we have. We came out with vaccines within months, most of the parts of the world. And now it's all just turning back over. And most risk assets were the most expensive ever. So a normal period of underperformance after a historic period of outperformance based on massive liquidity, zero interest rates, never happened before, is normal, is expected, is way it should. And I'm expecting to write the textbooks. And if I don't write the textbooks that way, I'm going to be confuzzled, but we'll take it a day at a time. For now, that to me is the next bridge to cross, is tilting over to this deflationary period. And bottom line is, if that stock market can stay up, that's great. The problem is every day it stays up, it keeps Fed finger on the tightening button.
Mike, I just keep wondering if this will be the time where the powers that be will finally allow the natural cycle of business, of economics, of credit to run its course. And I mean, I guess it's wait to see. But I mean, so, you got to ask yourself the same question, right? Like, yeah.
No, but I think you nailed it. That's what's my nickname's been McGlone, but that's one thing I think that's come out of this. The Fed has seen mostly 100 or so highly train economists see this is the time to cut the umbilical cord of every time the stock market is down 20%, the Fed ease and will save you. Now, I've gone back and checked the data. It's just exactly what happened, depending on how you measure it. It's finally time to do that and go back to an organic demand pull. Bad news is bad news and good news is good news market. And the Fed's not here to save you, but it's also very bullish for America, very bullish for North America, partly because of the system. Now, it's going to be a bit of pain, but if we handle it properly, I think it's going to prove that what is happening in China and Russia will prove to be an absolutely wrong decision, an absolute wrong way to go. Autocratic-led leaders trying to manage economies have proven never work. I really like how Atlas Shrugged covered that. But I do think that's the best thing to look out of it. Once we get through the system, if we have proper leadership, which probably means younger leadership, hate to say that, but it's true. But the guidance, I think, will be, okay, here's the scenario I look for. We're heading towards deflation. No more quantitative easing ever. We've learned that lesson. Rates can go low to 1, but then we have to work this out. We'll get through this. But sorry, we're not going to quantitative ease anymore. We learned the lessons of that. Fiscal stimulus, yeah, sure, we'll help you. If you're out of work, we'll help you. I hope we don't have to get to the work progress program like FDR had to get to, but drop rates low levels and let markets work this out organically. And out of that, you get a very elongated period of good, I think, prosperity. And also, no more debasing the currency, just not spending at will. And that's what we did during COVID is very scary. The amount of checks, the amount of fiscal stimulus without limit that we threw at the system was unprecedented. So maybe some checks and balances there. Maybe that's part of the reason I'm bullish gold. I'm still see gold as a very bullish asset. It's actually the average price this year is 1933. It's the highest ever. I love to mention that price because of the year. And there's only there's no other commodity or market you can say that about, no major one. And I think it's just going to do what it continues to do. I don't have to go to gold too much, but what you said, I think, is exactly what we should look forward to. But it's going to take proper leadership, and I guarantee you're not getting that leadership in what's become part of this significant war. It's World War III. It's cold and hot with U.S. and its allies versus China and Russia and its allies. I mean, that's just facts of what's happening.
Right. Well, and I wonder, Mike, if we'll look back in time at, this time that we're living in now and be like, that was the pivot point for another round of rebuilding, putting investment into infrastructure, into resources, into energy, despite however you want to look at that, whether it's traditional fossil fuel energy, nuclear energy, renewable energy, maybe it's all encompassing. But that idea that we have to be less dependent on the resources of other countries and more dependent on ourselves, if we will see a time for another, I don't want to say Green New Deal, but at least a new deal of some sort to put people to work and actually build things for this country to continue to succeed for another 100 years. Is that something that could possibly happen?
It's already happening. It was one of my first things I wrote about upon that invasion when energy prices spiked. It's happening fast. So let's give you first example. Total global sales of passenger vehicles before COVID was around 3%. Now it's 15% and rising. That's according to BNEF, Bloomberg New Energy Finance. Unleaded gas consumption in this country is about 5% below what it was before COVID. A lot of that's work from home, but I drive an electric car. It's almost 10 years old. I had solar panels in my house, and I did those with subsidies. But it's part of the key premise of the book Superabundance. I forget the name of the author in the book, The Price of Tomorrow by Jeff Booth. I'm friends with Jeff Booth, and it's just if you do not limit our ability to make things better and error correct every day, the U.S. will just continue to crush us. Now, China's doing that, Russia's doing that completely the wrong way. They have to steal intellectual property because they can't create it themselves. In this country, it's just a very good sign for McGlone to be bullish once we get through this correction period. But that's part of the reason I'm very bearish commodities. We can create more with less every day in commodities. I'll give you one example. Let's look at corn. I was just in the Corn Belt last week. We're just firing up for harvest. The average planted acre of corn in this country produces about 175 bushels of corn per acre. 50 years ago, it was half that. We've doubled the production from 1 acre. And what have we done then? We use less fertilizer. better seeds, better technology. Every day I hear it, I go out there, man, it's just we can't keep up with the technology is what I hear from the producers. So that's just food. And here's another little example in history. We use 20 or 40% of that corn for transportation for fuel. Well, before automobiles proliferate in the 20s, we used the vast majority of our agriculture land for oats and hay for feeding horses for transportation. So this is where it's going fast. So I ride electric bike to work. That technology is wonderful. It's nascent. I love to play with it as long as it's cost effective. But what I think you nailed is that's why I say America's going to crush it. As long as we don't mess up our venture capital, our innovation system, our universities, and our system that rewards people for taking risks and taking challenges and actually failing and moving on. I mean, what are we, according to Jeff Booth? We just a bunch of correct errors and we move on. That's what's going negative in places like China, in Russia. And that's where I think U.S. is going to really crush it. But in the meantime, we've got to get through this period of overextended, excessive valuations of risk assets on the back of the longest period, unprecedented period of zero interest rates in history. And it's just logical to expect risk assets to rise to higher levels when interest rates are very low and risk assets to go down when interest rates are high. Well, 5% on that 2-year note is well above inflation, still heading higher, and it's going to be squash, I think. It's going to just draw capital from all risk assets for now.
How about your outlook on mining and metals production in the West and United States? I mean, obviously we have great partners, trading partners out of Canada and Mexico. We're importing quite a bit, as you mentioned a while ago in this conversation. We can talk about food and we can talk about energy, but when it comes to metals and mining and putting pits in the ground or putting underground infrastructure for mining, there still seems to be a massive pushback here. Is that something that narrative changes?
Bullish gold versus bearish most commodities, but typically bullish metals versus most commodities has been the trajectory for 10, 20, almost 30 years. And the bottom line is the metals, let's just talk about copper, gold, are, and PGMs or wherever you want to go, are become harder to extract and expensive every day. And they're more in demand every day. Just electrification, decarbonization means copper. Now that's and also let's look at facts. Copper did make an all-time new high and the peak and that run up to 2022 and it's come back. Crude oil didn't. There's your tell. It's not going to happen. So the key thing about the metals and miners, Trevor, is depends on which. If you look like a broad index, you got to be a little more tactical because broad indices like the GDX typically underperforms the actual metal. I mean, you can store metal on your finger, or gold on your finger. You can buy an ETF, but that's the big difference. Is we have the demand side at least is strong, and we're not replacing it every day like we are with crude oil. We're replacing petroleum with technology, and that technology is creating that bid. So I like that side. In fact, one of my favorite indices I've looked at is just the Bloomberg All Metals Index and energy or agriculture producers, the equities in that index. Now that's kind of something that's the facts are they've performed well over time. Typically, and you don't have to worry about it. So I love the narrative when people say, oh, I'm just going to buy crude oil. Well, you have to typically in the long term pay the storage. The storage costs are typically the cheapest in the metals. I mean, you can store gold in the bottom of the ocean for thousands of years. Now, copper will decay, but silver is pretty good there. So that's why I really like to differentiate. But I'll end with this. One thing that's been happening over the last 1 year, 5 year, 10 year, 20 year, almost every increment is gold beats almost every commodity, beats copper. It certainly beats the energies, petroleum, and certainly beats ags because gold is, as JP Morgan said, money, and there's a limited supply, and every day we go by, there's more supply of fiat currencies, how you measure it. But that's one thing you always remember. Gold typically outperforms, particularly as we tilt towards recession. That's part of the reason I'm bullish gold. And I've been pointing out for the last few years when I speak to my metals team in London that, Mike, what's your call for this year? Long gold, bullish gold, bearish copper. And that gold-copper ratio I fully expect is going to continue to advance until we get past this period of this inevitable global recession. So I'll just point a little fact there on the global recession. Now, obviously, you see all the diminishing data out of China. I mean, it's train wreck happening. I point out some of those things. So that's kind of to the wayside. PMIs, producer price indices, services and producers in Europe are all negative, yet they're still hiking rates. So there's a recession happening. Germany has arguably been in recession since late last year. And then it's just a matter of time, the world's largest demand pull economy in the U.S. Our model for recession in the U.S., our economics model is at 100%, the Bloomberg economics model. Now, admittedly, we were early, started that a year ago, but there's things happen that delay the term for us. But it's just tilting that way. So typically in that environment, gold outperforms everything.
I have had, I mean, obviously long term, I'm very bullish on the base metals, including copper, anything regarding the electrification of everything. But in the short to midterm, Mike, I've just been very concerned about getting through this macro, this mess we're in, heading into a recession. And how, like, I just can't come to terms to being very, really bullish right now. Do we have to get through whatever it is that lies ahead of us before we can be like all clear with the bullish call in base metals?
So I wish bullish calls were that all clear, but I agree with you. First, I like to look at copper. It's $3.76 a pound. If you take the S&P 500, divide by 1,000, it's basically the same price as copper since 2015, except the S&P 500 has gone up recently, copper's gone down. Can't be bullish copper until we see something. Right now, what's happening in China, you mentioned the Hang Seng Index. I like to watch it, the CSI 3000. Those are all pointing towards, and what's happening in China is just the major demand pull source for the last at least 10, 20 years is heading towards recession. Copper's going to have problems. So I think copper's going to go back to $3 a pound. That's not profound at all. That's about where it was before COVID, before this biggest pump in liquidity. I think the S&P 500 is going to follow that, go back to around 3,000. It's not profound at all. It's what it typically does in a recession. It's right where it was right before COVID, around there. And I think Bitcoin's going to go around 10,000. We don't have to go there too much, but those are some of the major ones I watched. But that's the key problem with copper. I need to see some kind of divergent strength given the very bad fundamentals. And all I see is certainly versus the stock market. On the year, copper's down 1%, gold's up 5%. That's the body. It's the rising copper to gold ratio I expect to continue for a while. And we need to basically, for these things to bottom, it typically takes complete despair. And we're nowhere near that. I mean, you got to really have people give up. And we got pretty cheap early. When that bounced to the new high above $5 was great, but it was so suspicious. And then it dipped to just below 3. I'm looking at in July of last year, and the bounce again. It's just like typical pendulum swinging market. But in the long term, I agree with you. Copper is going to go up, but I do expect. Right now, I have a target, but I think it's more likely to head towards 3 before it starts a longer-term upward trajectory, and that's normal given. Again, most central banks on the planet ever are still tightening rates. That is not good for copper.
The one outlier here that has surprised me, and we talked about China a while ago, but that is iron ore. Iron ore remains very strong, and China continues to be a big importer despite their glut of economic news coming out. That is something that surprises me. And I don't know if you have any insight or thoughts on that, but it's really incredible to watch right now.
Yes, I have to admit, I don't watch iron ore as close as my colleagues in London do. And the key point I'll make about iron ore is I always like to point this out. It's the same price as a decade ago, about $112 a metric ton. And so we've had a bounce recently, yes, but it's off, almost 50% from last year's high, of 2021 high. And that's the problem with most commodities. But yet what's happened to global money supply and economy, certainly the Chinese economy in the last 10 years. I'm going back to 2012, so a little bit more than 10 years. And so be careful. That's one thing I always like to point out is be careful with the little nuances and the fluctuations, which will make you lose your hair, versus the big picture macro. But here's the thing about iron ore. It's a little bit off my radar. It's not traded in any of the major indices, the Bloomberg Commodity Index, the S&P GSCI. And so it's not as the liquid. It's not as, I focus on copper more for my Dr. Copper indications. But the key thing to remember, iron ore is definitely bouncing recently, but same price as a decade ago. Can't say that about most other. Imagine if we said that about the stock market. Now you can with the Nikkei, you can with the the Euro Stocks 50, a lot of indices, but not with the U.S. stock market. That's part of the problem with commodities. They are significant deflationary assets. They deflate. They do not keep up with money supply, do not keep up with most other things. They fall versus money supply, fall versus GDP. Iron ore is a good example of that.
Okay. Mike, before we let you go, I just want to ask you kind of, things we should be watching closely. If there's specific items, September is a very volatile month historically for markets. What are we watching here? There's a lot of chaos, but what are maybe one or two things that you're keeping a close eye on as we progress through this month?
It's typically the worst month for the grains, obviously it's harvest, and for the stock market. And I'm concerned about what might happen in China. So definitely the number one barometer for right now for all risk assets is if the stock market can stay buoyant this month. But it can't be easy. Even if it does stay buoyant, it might tilt over later. So that's the number one metric. Like, for instance, crude oil's bumped up to near $87 a barrel. If the stock market rolls over, everything's going down. It's just going to go down with a higher velocity. It'll drag everything lower except gold in the longer term. So number one is the stock market, and the number two, and that's markets. Fed is, they're going to react to the stock market. It's China. It's not China. It's Mr. Z. What you just mentioned when we started this podcast and this review is what's happened with Apple. Those things that you see out of China, to me, are just trees in the forest of what's been happening and should continue to happen. And it'd be wonderful to see a major shift there. But China and the war, remember, we got a hot war that's going on. It could go nuclear. I'm worried about the CEF issue where these leaders might go out and, someone else's fault, try to conjure something up to get their the animal spirits going in their population. But Mr. Z, what he does, and that was kind of my goal, is to go back and reread and restudy everything I can about him and his personality. But I will point out key facts. Watch what he does, ignore what he says. He has unlimited friendship proposed with Mr. Putin, pushed back on Alibaba's Jack Ma, and our president has warned about a ticking time bomb. Now, typically, I'm not getting political. I'm just pointing out we did see a good example of some of the things you hear from the president. Right before Russia's invasion of Ukraine, Mr. Biden said some very profound things that turn out to be true. The intelligence, don't underestimate we have 18 different type of intelligence agencies in this country. So there's pretty good intelligence.
Mike, I appreciate your time. How can people follow you? Twitter handle. I know people who got the Bloomberg terminal can find your stuff as well.
Yes, I'm first of all on the Bloomberg terminal. On Twitter at Mike McGlone 11, and LinkedIn. Just look up for Mike McGlone and Bloomberg, and I'm happy to add people to my distribution list. Just shoot me a LinkedIn or DM and ask me and get your email. But and I'm happy to friend people and to hook up with people. So, and I appreciate you having me on, Trevor. I enjoyed this conversation. I enjoyed getting to know you and meet you. And
I appreciate it. I actually, funny story. Like, I first saw you give a presentation in New York. Oh man, this was prior to COVID. This might have been 2019. And I was just blown away with how informative you were. It was a dynamite presentation, and I feel a little bit of shame for not asking you to come on since then, but I'm glad we got to make it happen now. Thanks, Mike. I appreciate it.
So one benefit I have in BI is having been there, done that in a lot of markets is I'm not running money. I don't have a bias. And the number one thing I have to admit sometimes, and I'm guilty of it all the time, is admit what I'm wrong about first. What does that mean? And move on. And that's one thing I love here is people might say, oh, you could speak with such conviction. And I'm kind of paid to do that. And then I saw in the chat the other day, said, well, you're paid to be right, to make money. And so I'm just try to focus on what really matters, and particularly if I think people are missing something. In this case, and it's my duty, I think, make sure people see the facts of, for instance, this soft landing. Why just turn off CNBC and look over that tune at 5% and say thank you, see you in 2 years.
Well, you don't even have to watch me to just go take a walk around. I mean, if you live in an urban setting here in Denver, I've seen it appears that there's less construction cranes in town than there was a year ago. I was back in Vancouver, BC 2 weeks ago, and I saw more shops closed each block than there were 6 months last time I was there. And there's just a lot of things. You don't have to, follow charts every day to just see things slowing down. I think that's obvious. So just my 2 cents.
Yeah, it's typically peaks are made when the cranes are at the max, and what you mentioned are trends that are just getting started, and we don't even see the beginning of liquidity that usually stops these things.
Right. Okay. Mike, thanks again so much for your time. And everybody, thanks for listening.
Thank you.
We're going to be back Monday, not with the morning briefing. We have some updates, but then we'll be reporting from the Beaver Creek Precious Metals Summit. This is Trevor Hall signing off for the weekend. Have yourself a great couple days.